In every month, without exception for the last 2 years, funds focused on investing in UK companies have experienced net outflows of capital, as both international and domestic investors have reduced allocations. This weakening sentiment has been felt most acutely in the UK by smaller listed companies, which now trade on valuation multiples akin to prior periods of significant market distress. Today, we'll discuss whether there might be catalysts on the horizon for a turnaround in the prospects of this segment of the market. Hello and welcome to the Investor Insights podcast, hosted by Killik Co. My name is Gordon Smith, and in each episode, I'll be interviewing portfolio managers from across the investment industry to gain from their expertise in the specialist areas in which they invest, and to question them on the topical issues of today. Killik Co is an independently owned wealth manager which opened its first office in 1989 and provides services to help families save, plan and invest. And you can find more details of the unique ways in which we do that on our website, killik.com. In this episode, we speak to Roland Arnold, portfolio manager within the emerging companies team at BlackRock, and whose primary responsibilities include managing several small and mid-cap focused UK equity portfolios, including the London-listed BlackRock Smaller Companies Investment Trust. Against the backdrop of the unique challenges posed by the global pandemic, increased geopolitical tensions, and the significant shift in the economic environment, it is perhaps no surprise that indices tracking smaller businesses, which tend to be less mature and more sensitive to financial conditions, have underperformed larger capitalised businesses within global markets over the last several years. However, the degree to which performance has diverged between large and small segments of the market, and the length of time this has persisted, is a rare occurrence when looking at long-term market returns, and at odds with the long-term feature of markets, whereby broad baskets of small and mid-sized companies have significantly and consistently outperformed their larger sized peers when looking at long-term holding periods. Crucially, the more recent period of relative underperformance has not coincided with proportionally lower earnings growth, meaning the relative valuations between small and large companies has widened considerably. All these factors suggest investors should not overlook smaller companies when re-evaluating portfolios at the current time. In addition to the depressed valuations to which the underlying UK small-cap portfolios are currently trading, we viewed this as a timely point to speak to Roland, as the share prices of many UK small-cap investment trusts, including BlackRock's, currently trade on far wider discounts to their prevailing net asset values when viewed in the context of history. These discounts reflect the weak sentiment at the current time, in addition to being a consequence of recent investor flows away from UK investment trusts, but offer contrarian investors the opportunity for enhanced returns should sentiment improve and discounts narrow. Roland, thanks so much for joining us today. How are you doing today?
Pretty good so far. New year, so I think we're starting the year with a fresh and positive outlook, way that most people do.
Yeah, great. Yeah. And so to start these conversations off, we've been kind of trying to get a bit of an insight into the kind of working week of an asset manager. And as you say, we're actually recording this pretty early in January, so I hope you've managed to have a bit of a nice break over the last week or so. But I mean, would there be kind of perhaps any anecdotes from recent company meetings or insights from a research trip that you might be able to share with us, or perhaps just even an article or a book that you've been reading recently, just to give us a kind of an insight into your working week?
The working week is one of those things that changes in response to what's happening in the markets and the volume of news flow. This is a particular point of the year where actually the first week and the last few days have all been relatively quiet and give us some time to think about portfolios and what we think about the year. But the news flow is about to absolutely kick off in the next few days. And that suddenly becomes the thing that dominates the working day. For us, for me, and for the team that I work with, we are very much bottom-up, company-specific investors. And so most of what we do with our day is that news flow that comes out in the morning, but then it is meeting companies, either the pre-arranged meetings on the back of annual results, or the ones that suddenly get put in the diary because the statements come out that morning that means you need to speak to them for either good or bad reasons. And I think given the strength and the size of BlackRock and the holdings that we have, our corporate access is obviously second to none. And so we do utilize that to see as many companies as possible, both at BlackRock and out on the road, actually seeing them on their site. So the vast majority of the days on normal news flow days are spent with that, analysing the news that comes out in the morning and then speaking directly to the companies themselves and all the benefits that comes from that research process. In terms of anecdotes from recent meetings, again, we're at a strange juncture of the year where the meetings haven't quite kicked off yet for 2024. And obviously, we had the wind down from 2023. So for the last 3 or 4 weeks, I haven't actually done much in terms of company meetings. I think generally speaking, so rather than sort of as an anecdote, I think it's fair to say that most companies have come through a pretty torrid time in terms of their share prices, but actually not necessarily such a torrid time in terms of their earnings. And there's lots of management teams sort of looking at the valuations that they sit on, slightly perplexed given how well they feel they've delivered over the last 12 or 18 months in some really quite trying circumstances. So I think that's the general feel I get from most meetings. In terms of the current reading, I'm currently reading a book called Watford Forever, which is all about Elton John's Tailor-Made Army and the friendship between Elton John and Graham Taylor at Watford. And I'm not a Watford fan. At university, I lived with an absolutely mad Watford fan, and so I've always kind of kept an eye on their team. But it's quite a heartwarming book, reading the relationship between these two polar opposite people and how you could still in that time of like the late 70s, early 80s, still turn around a football club with a beneficial owner that had put in too much money. And as a Leyton Orient fan, it's kind of a story that I look on fondly and hope that someone may look at my particular area of East London and do the same at some point.
Yeah, good stuff. Yeah, nice to have a book recommendation. Thanks for that. So yeah, you mentioned the kind of the challenges a lot of company share prices have had over the last year, 18 months or so. And on an index level, the UK small cap market in particular does look attractively valued against its own history, but also relative to other geographies, other markets around the world. And there's some kind of, I guess you can pick up a number of kind of obvious reasons for that, with the UK specific, whether it be kind of turnover in political leadership, et cetera. But I wonder, do you see kind of other reasons why the UK warrants a lower rating, or how do you view the current discount that you're seeing in the UK small cap market?
I view it as a puzzling anomaly. But one that maybe isn't that puzzling, because I think I know what the answer to it is. I mean, there are many reasons why people suggest that the UK is trading more cheaply than other markets. And you mentioned that, the turnover in prime ministers that we've seen, the ongoing potential impacts of Brexit, sort of the whole political who's going to be in power in the next few months. There's lots of reasons to dislike the UK, but as we all know, it's been all over the press in the last few days. Part of the world is going to have an election this year. The UK is not alone in facing a potential change of leadership. Huge numbers of countries and population will be facing the same. So that in itself isn't a reason. The UK economic outlook and economic performance is no worse than anybody else's at the moment. Even the slightly tricky inflation numbers are starting to come back down again. And some of the increased inflation over what we saw in Germany and France is explainable by things like national living wage and other bits coming through. So the specific reason behind that don't look quite so good. Our COVID performance has been, re-examined and reanalyzed and doesn't look as bad as perhaps people thought it did at the time. So lots of the things that people put towards the UK, I don't think are necessarily valid or a real reason for this. And you're absolutely right. The UK small cap benchmark is trading at a discount to mid cap and large cap, which is not in itself unusual. It's trading at a discount to its own history, which that does happen, but it is quite a marked discount at the moment, and trades at a discount to many internationally comparable small cap indices. Although we do have to caution the UK is a very small cap index, and others aren't quite the same. So there are some differences there. I think the answer to the puzzle is purely flow. The flow in the UK has been absolutely appalling. And continues to be so. There was some suggestion that maybe November and December looks slightly better, that maybe we're at the end of this 26 or 27 months, whatever it is, of consecutive outflows. There's 70 of 90 months of outflows driven by all of these sort of issues and shenanigans. And the question, rather than why is the benchmark cheap, should be what's going to make people look at the UK market again, and where's that flow going to come from? Some of it comes from companies themselves, the large amount of share buybacks that we're seeing right now, but ultimately we need to get people to re-engage with the UK market again. We need to get some quality into the UK listing. We need to get the IPO market reinvigorated. We need to get M&A coming back. We need to get those sort of animal spirits of management teams back again. We need to get successful placings away. There's all those sort of things. But once that does start to happen, and catalyst for this is totally, indistinguishable, indeterminate, whatever the right word I'm looking for here is. It's this intangible thing that just suddenly happens. I don't know what the catalyst was in 2009 or in 2002. It just happens. But when it does, that flow comes back, and that will itself correct some of the valuation anomalies that we see within the UK. So it's all about that positivity and the outlook of the end investor and bringing that back into the UK market.
I guess one of the kind of factor is that the UK equity market isn't necessarily a kind of measure of the UK economy. If you look at the kind of large cap segments, there are quite some biases there, whether it be to the banks or oil and gas or pharma, etc. But within your kind of universe, that kind of small and mid-size companies, would you say is relatively diverse? I mean, you're not necessarily having to go for UK domestic exposure necessarily. It is a pretty broad set. Would that be fair to say?
Yeah, I think that's absolutely fair. I think one of the reasons why UK small and mid did so poorly against large cap in 2022 wasn't because of the components of UK small mid. It's, to your point, it was what made up the FTSE 100. So in a world where people were looking towards value in a rising yield environment, when resources prices were going through the roof because of geopolitical events, a benchmark that has a huge amount in oil and gas, a huge amount in mining, and a huge amount in banks is clearly going to outperform a benchmark that has much less of that, particularly with a flow dynamic that sits behind it. So there is a very different index composition and makeup between the two. Ultimately, in UK small mid, what you've got is a bunch of industrials, now much more high quality industrials than we used to have when I started running money 15, 20 years ago. You have a bunch of financials, you have a bunch of consumer stocks, and you have a bunch of media stocks. And then there's some peripheral, there's some support services, there's a few resources that sit within there, but essentially those are the big chunks. And so not necessarily all domestic, there is clearly a domestic element to that, but certainly the media and the capital goods side of that benchmark is very international in its operations and its outlook. And the way we try and do things, we are quality growth investors. And by definition, if you're a growth investor, well, most growth is going to come from outside of the UK shores. So we typically speaking are underweight domestic earnings and domestic revenue versus the benchmark in our portfolios.
You mentioned in an earlier question kind of what might be the catalyst to that kind of re-rating, and it does appear that there's been an uptick in interest in private equity towards the UK, perhaps towards the kind of second half of last year particularly, as well as we're seeing kind of activists appear in some areas of the UK markets, kind of build holdings within the shareholder registers. I mean, are you able to give us a sense of just kind of how significant you think that's been so far? Is that potentially early signs of a sentiment change?
I mean, I think what's the best way of answering this question? I would like to think those are hopeful signals of an improving market in the coming 12 or 18 months. The reason why I'm being cautious on it is I feel like in the last few years, certainly since Brexit, maybe just before, I keep feeling that there is this period where actually this M&A process is going to start because UK assets look cheap for whatever reason, and there's some political stability that's there. And let's face it, most people aren't going to, regardless of how cheap the asset is, if you don't know what the political environment is, it's very difficult to invest in an economy or in a geography. And so with the tail effects of Brexit and then the tail effects of dealing with Brexit and then COVID, it's always been something that sort of stopped that process. Now, hopefully, with fingers crossed, lucky rabbit's feet, whatever else we can put in there, hopefully there isn't something else that's going to cause a disruption to that stability that could be there. Notwithstanding and fully accepting there is an election coming this year, but I think we all have our view on what probably is going to happen during that process. given the valuation, I think, that sits within the UK, I would expect to see that M&A process continue. And we have obviously seen in the last few days, weeks, months, as you suggest, and you said that there has been some activity. We've had both on the corporate side, we've had some activities like Young's buying City Pub Company. We've had Mars buying Hotel Chocolat at an enormous premium. So there has been strategic buyers as well as just private equity buyers looking at the valuation and the asset and feeling that there is an arbitrage to play there. There has been both sides of it going on. Just before Christmas, we had the Harbour Energy deal, which is an absolutely enormous fundraise, with the party taking shares at significantly above the screen price as it was at the time, which shows that strategic players are seeing not just the screen value, they are seeing real value at prices above the screen value for some of these assets. So I would hope that continues. I think the signal for me in terms of management teams and feeling that their own paper is attractive or the valuations they sit is attractive, is just this huge amount of buyback that is going on in the market right now. I've never seen such a wide scale a range of companies buying back their own equity. Typically speaking, it used to be more liquid shares that were doing it. But we're actually seeing it further down the market cap spectrum than I've seen before, and a much wider range of companies than I've seen before. And so back to that, we just need some flow in the market to start to realise some of that valuation. Some of that flow will come from companies utilising their own cash flow. And it definitely feels like there's a preference in doing that through buybacks, given the valuation, than through special dividends. So I'm hoping the corporate activity continues. I'm hoping the M&A activity continues. I'm hoping companies and chief executives and management teams rediscover their animal spirits and are prepared to utilise the markets and conduct their own M&A to grow their own earnings and give us accretive deals. But even regardless of all that, I still expect the buybacks to continue, given the level of cash that sits within the UK market, and that in itself should be support.
Well, if we could maybe delve a little bit more into the portfolio itself. I mean, the economic environment in the UK and everywhere in the developed world, has changed. I mean, it's a regime change really in rates and in inflation expectations. I mean, what do you see as the kind of prospects of the portfolio given that change? I mean, are there perhaps general themes to changes that you've made to the portfolio over that period, or are there kind of characteristics in the constituents of the portfolio that you're looking at in order for them to kind of withstand this kind of new environment? You can maybe talk us through kind of the prospects of the portfolio.
So there's a couple of points there. The first one, said earlier on, we are quality growth investors. That is the philosophy that sits across all of our products on the emerging companies team. And there is a reason for that. Which is that when you are investing certainly further down the market cap spectrum in small and mid cap, you're taking a lot of risks. You're taking liquidity risk that comes with the fact that these are just smaller companies trading a smaller number of shares each down the market. So it's more difficult to move in and out of positions. You're taking maturity risk. Quite often these are single line businesses, single product, single service, whatever it may be. So their revenue streams are far less diversified, and specific issues in specific industries can really impact on share prices. You're taking just the fundamental risk that comes with investing in earlier stage companies. They're just not as well known and not as well covered, all of those sort of issues that sit around. So for us, if you are taking those risks, the reward on the other side has to be the companies that grow. We're not interested in taking that immaturity risk, that liquidity risk, that small cap risk, and then having a company that delivers 3 or 5% earnings growth a year. That's just not attractive in terms of the reward for all of the risks and issues that you take. So philosophically, we always lean towards growth within our investment philosophy. Now, it's absolutely fair to say that given a world of zero interest rates that we went through for a number of years, certain pockets of growth did get overstretched in their valuation. Particularly, and I think it's fair to say that sort of unprofitable earlier stage venture finance, where it's just much harder to try and put a theoretical valuation on some of these businesses because the earnings are so much further out. But it's also fair to say that growth companies, profitable growth companies within the UK in certain areas, did get extended as well in terms of their valuations, and that valuation premium has come back quite substantially. Sitting where we are today, I think it's fair to say that the premium for growth companies doesn't feel particularly large at the moment. If we can buy decent quality growth companies with multi-year opportunity sets in front of them on 13 to 15 times earnings with balance sheets that are either net cash or near net cash, that feels attractive to us. And so we now see many opportunities with businesses with those sorts of valuation opportunities and those sort of growth dynamics that we find attractive. We see plenty of those in the market right now. The issue comes back to the earlier point. It's about flow. Until we start to see some flow in the market, people aren't going to distinguish between stocks. They're just going to continue buying probably the same stories that they have done before. But it's just the incremental is very low because you haven't got that flow coming into the market. It's actually more now. People thinking, what are they going to sell? So when you look at your portfolio and you're selling to meet flows, you're still going to sell those things that look a little bit more expensive if the growth outlook is a little bit better than it has been. So I think, again, the end of that outflow, start of inflow is really important for that valuation realization in growth stocks. I think it's fair to say that and we shouldn't forget that actually when you are looking at UK small and mid cap, whilst we are growth investors and there are value shares that sit out there, almost by definition, most UK small and mid cap growth companies are growth orientated. Management team enlist on the London market to take advantage of capital markets, to raise money, to grow their businesses more quickly. And so I think whilst there is that growth value comparison and argument, I think the UK market lends itself into more mid-cap towards growth investing anyway. So I think it's also less of a question from that point of view.
That's just a final question, and hopefully not the trickiest question. We've been asking to finish these discussions what perhaps your highest conviction area of the portfolio is at the moment. I'm not asking you to choose your kind of favorite holding. That doesn't necessarily have to be a single stock, but is there a kind of area and a trend or theme or a sector that you have particularly high conviction in at the moment that's represented in the portfolio?
Yeah, I think the area we've been talking about most for the last 2 years, probably, certainly since COVID caused such disruption to supply chains and the inflationary effects started to come through, is this whole investment that is going to need to happen in the supply side, in supply chains. And this is not just about shortages of stock and shortages of material that have caused disruption in certain areas and certain industries whilst they await this golden screw to finish off whatever product it is they're making. This is about fundamental reassessment of just in time versus just in case in terms of supply chains. This is about industries making sure that they've not got one supply chain, that they're dual sourced and triple sourced for everything that they do, so they've got replication and backup. And then this has been augmented by geopolitical issues, whether it be the IRA Act in the US or various others, how difficult it is to deal with China in certain areas. The mean that actually people have to look at those supply chains. And we're going to see much more nearshoring or friendshoring of supply chains. So there is going to be a big capital investment that comes with that. And that's been augmented by where we are in terms of inflation and labour availability. Labour markets are still tough. It is still difficult to find the right people for the right jobs. Whilst wage inflation has started to moderate, it is still higher than it has been for some time. So in an environment where it's harder to find people and they're more expensive than they used to be, there's clearly going to be an investment in productivity that is used to offset that labour requirement. And I think when people look at the productivity puzzle that is the UK for the last 2 decades, and why has that productivity been so low? My answer to this has always been the same. That was because we relied too much on cheap labour. When labour is moving to 0-hours contracts, it's not very expensive or very difficult to hire more people, particularly in an open market environment. Then you just threw more labour at the problem. And if growth didn't get to where you thought it was going to, or because there were 0-hours contracts or flexible staff, you just got rid of them. They became a flexible cost source or a flexible cost base to help grow your businesses. That environment has changed. And so actually, rather than just relying on labour, you're going to have to find ways of making existing labour more efficient. So I think the changing and the repassing of supply chains, along with the cost of employing people, means there's going to be investment in productivity and capital. So the cap goods sector and the software sector both look like areas to us where we could be at the start of a multi-year period of expansion. We just need to get through the next few months whilst everyone's thinking about their inventory levels and their own economic outlook.
Really interesting. Roland, thanks very much for your time today. Appreciate your thoughts as always. Thank you.
Absolute pleasure. Thank you.
Thank you for listening to the Investor Insights podcast. You can contact info@killik.com, referencing the podcast for more information on any of the topics discussed, or for further details on the services offered by Killik Co. This podcast is not personal advice. The content is intended for educational purposes only and is not investment research or a recommendation to buy or sell any financial instrument or product, or to adopt any investment strategy. The value of your investments can rise as well as fall, and you could get back less than you invested. Past performance is not a guide to future performance. The investments referred to in this podcast may not be suitable for all investors, and you should seek advice from a qualified investment advisor. Killik Co is authorised and regulated by the Financial Conduct Authority, the FCA.